Hi, welcome back to the podcast, HOA Hell. I'm your host, Michael Kushner, and with me, as always, is Senior Associate from MBK Chapman, Sam Kill. Sam, hi.
Hello, Mike. Glad to be with you.
Glad you're here.
Thank you.
Sam, we recently did an episode of our podcast on SB 625 and, the Altadena and Palisades fires that ravaged parts of Los Angeles in early 2025, and how SB 625 was a direct result of that disaster, that declared disaster. And we got a lot of response to that. And I followed up with, I had previously written 2 fact sheets on our website. I'll put links to those fact sheets in the description. But I had previously written 2 fact sheets on different aspects of SB 625. And I recently wrote a fact sheet on the devastation of the fires and how it's led to various HOA changes. And on top of that, we started getting, in the responses we were getting, we actually had a few people come in and they actually retained the firm. Relating to a massive special assessment that one of them faced who lived in Altadena. And there was I did an article or a fact sheet on that. I'll put a link to that one as well. And we've heard from a few people who live in these high fire zones who were stuck on the FAIR plan.
Right.
And so today's episode, we're going to talk about California's FAIR plan and how it affects the rebuilding after a total loss, like in a major fire. And we're going to be very specific and tie it into what we're seeing now as a result of the Altadena, Palisades, Malibu fires, and how and why the FAIR plan is doing that. That's really what we're going to talk about today. Now, I'll start by saying the FAIR plan wasn't passed or didn't come into effect as a result of these fires. It came into California law in 1968. It actually came in as a result of the Watts riots.
That's right. Yep.
There was a lot of people fleeing the areas where the Watts riots were, and a lot of insurance companies pulled out of the market, and the FAIR plan was passed to kind of provide stopgap coverage for people who lived in those areas where insurance companies have vacated.
Those urban areas, yeah.
Right. It just so happens that the FAIR plan is the only, when insurance companies started leaving California or pulling out of providing fire coverage in certain high fire zones in California, it's the FAIR plan that steps in and provides that coverage to those innocent homeowners. So that's really why we're discussing it today. So I'm not trying to say that the FAIR plan had anything to do with the fires, but it is the only structural coverage, right? Coverage for a loss in a fire that homeowners have if insurance companies have refused to renew or won't even write them policies because of where they live. Palisades, for example, large parts of the Palisades, it doesn't matter how valuable your house is, you're not getting traditional insurance from Farmers or State Farm or Allstate. They're not offering it. Not there.
Yeah.
Okay, and so what do? Well, you're in California's FAIR plan. So we're going to talk about what the FAIR plan is. Sure. We're going to talk about why so many homeowners have been pushed into the FAIR plan in the last, 10 years. And then we're going to talk about why that's happened. And then we're going to talk about, well, there's no solution per se for this. But there are some things that can be done. But these are policy changes that would require, organized efforts on the part of the voters in California. And I'm going to be very, very clear when we get to that section that we're not being political at all. We're simply going to tell you what options there might be that could help.
Right.
But who knows?
And really at the core of this is also fully understanding what this constitutes, what this program constitutes, and what the limitations are.
And let me be clear. This program serves a very necessary purpose, because if it wasn't around and you lived in a high fire zone and you could not get insurance, you would lose everything if your house burned down. I mean, think about it. Most people I know don't have unless they're much older, don't have their homes fully paid for. They are paying mortgages, and they might have a lot of equity, that sort of thing, but they're still paying their mortgage. If they had no insurance and their house is gone, this would ruin the majority of people in California that are homeowners in high fire zones. It would ruin them.
The overwhelming majority, I mean, you alluded to it, their home is their single most valuable asset. I mean, that's all
For
they
most
have.
people,
For most
it's their
people.
biggest asset.
Yeah.
Okay. Right. So in short, what we're going to do today is shine a spotlight on a very different problem than the one that SB 625 solved. Real quickly, SB 625 solved the how do you rebuild once, assuming you have the money, how do you rebuild? Like, how do you get through the red tape? And that's what SB 625 was about.
Streamlining that process, yeah.
Right. But the FAIR plan is where the money comes from to rebuild, and that's what we're going to focus on today. Right. So with that in mind, let's start with what the FAIR plan is and why so many Californians are on it now. So I've already talked about its origins in 1968, talked about that. And we talked about the fact that it wasn't created for wildfires. It just happens to be what's around now.
Evolved over time.
Exactly.
Yep.
So the FAIR plan, as it stands today, is funded not by the taxpayers of California. It is not a government-run program. It is funded by all the private insurance companies that do business in California, even the ones that have pulled out of offering fire coverage, but they're obligated as a condition of doing business in California, they got to pay into this thing. Okay? So every major insurer, and I named a few, the big ones, right, that write property insurance in California, even though they might not write it in certain high fire zones.
That's right, yeah.
They are required to participate and share in the risk. The risk being there has to be some coverage for the homeowners where you're not providing coverage where they live. So you have to pay into this fund so that they have catastrophic coverage.
That's right.
Okay?
Yeah.
So this is a system that insurers are forced into when the private market no longer works. Okay? Now, thank goodness for that FAIR plan for these people, because move forward a few decades beyond the Watts riots and you get to the last many years, several years. I said 10 years, but I didn't look at that, so I don't know. Where we started seeing more and more of these large wildfires. And we're going to get into a little later in this show. I don't want to do it now. We're going to get into why we're seeing, or we have been seeing so many more wildfires. It's not as many people's knee-jerk reaction might be, oh, it's climate change. Well, that could be a factor. There is no one reason that this has happened. There are lots of reasons in play. And in any given situations, which ones are more involved than others, I don't know. There probably are fire scientists out there at some universities throughout California that study this that might know it, but it wasn't for me to know, and I don't need to know it for what I do. But there are lots of causes, but climate change may just be one of them. But we're going to talk about what those are that I believe, and the literature at least has stated, is the cause of the upswing and severity of wildfires we've been seeing in California over the last, again, I'm just saying decade, just for the sake of having something. Anything you want to add to this part that we've talked about so far?
Just the one, I guess, common way of referring to this program, which is it is in fact a program of last resort.
Oh gosh,
and you said it in various different ways, different permutations of it, but it is really an insurance of last resort. It's essentially a stopgap in many ways.
It's a stopgap, but it's also the only insurance that is available to these people. In other words, these people at some point in time, before insurance companies stopped offering it, had full coverage, lost it because their insurance policy either expired and then the insurance company wouldn't renew it, or they bought into a high fire zone and couldn't found out that they wouldn't get new insurance, or insurance company wouldn't write them insurance for the buyer, right? Yeah. So these are people that were involuntarily pushed out of being insured.
That's really important.
We're not talking about people that, and I don't know anybody that does this, but because a lot of mortgages require you to be insured, that's an issue. But I don't know anybody who goes, yeah, I'll take a gamble. I don't need insurance.
What you just said, involuntarily pushed out, as opposed to
Right.
voluntarily electing not to renew because of costs.
Which
that's different.
I don't think I don't know if that happens.
Right.
But if it does, it's dumb. Okay? So bottom line, wherever we are because of all these fires, et cetera, where we are is premiums when the FAIR plan kicks in, when you are pushed off of traditional fire coverage, and we're talking structural coverage here. We're not talking about personal property. That you can get supplemental insurance for your piano and your clothes and your furniture and your antiques and whatever. You can get that. We're talking about rebuilding your house. Right? Okay. Yeah. So what we see with FAIR plan is that premiums go way up. You pay a lot more for FAIR plan coverage than I pay for my State Farm coverage. Okay. And at the same time that premiums skyrocket for those people that are on it, and it's better than nothing, right? Mm-hmm. Coverage does go down.
It does.
Because there are, and we'll get to these, there are limitations on the FAIR plan. So people are now paying more for a product that gives them less.
That inverse relationship for those fire-prone areas, unfortunately.
Yeah.
Mm-hmm.
Now, let's layer that on what's happening in the real world. We've already done that because these are no longer theoretical risks, at least for the people who live in the Palisades, Altadena, Malibu, and other parts of LA that burned during that same firestorm, beginning of 2025. This is not a theoretical issue. This happened.
Yeah.
And there are homes that, you might have a neighborhood with 200 homes in it and 10 or 15 or 20 or 25 survived for whatever reason and the other ones burned down.
Yeah.
That I personally know several people in the Palisades because remember I went to UCLA Law School. I used to coach soccer there. I have friends that live there. Some of them, their homes survived. The fire jumped. Mm-hmm. Where neighbors lost their homes within 50 yards, right?
And we just recently, you referred to it just as recently as last 2 weeks, met with several people who were in those circumstances. Either their homes were destroyed and neighbors' homes survived or vice versa. Yeah. Right.
So last thing to say on this part is that the FAIR plan, I think it's fair to say, was never designed to match modern rebuilding costs. Post-COVID, I don't know if everybody here remembers what supplies cost and food costs, pre-COVID and then post-COVID, but it went up dramatically and it's never gone back down.
Yeah.
It is dramatically higher than the supposed cost of living increase, right? And so the supplies, wood, nails, it doesn't matter. Stuff you buy at Home Depot.
There's a shortage on lumber, and now we have tariffs, you have gas prices, everything else contributing to that too.
All that stuff went way up.
Yeah.
Okay? So the FAIR plan was never designed to account for costs that go up that fast. And it certainly wasn't designed to operate at the scale that we're seeing today. Mm-hmm. If you think back to when it started, it was supposed to be more isolated. It was not something that would be ubiquitous. It would apply to very specific areas and the homes in those areas. But we have in California lots of high fire zones where traditional insurance companies have pulled out of coverage. A lot more scope than the FAIR plan was ever actually designed to cover. Mm-hmm. So I think we've talked about what it is. Let's talk about what it's not, what it doesn't cover. Okay? It's different from a standard homeowner policies because it's limited. It's more limited. Mm-hmm. And that makes sense for what it is. Okay? It's bare bones fire insurance. Stopgap is the word you used, right? Mm-hmm. Tell me a little bit more about what it's not.
What it's not is it does not cover certain types of events, like let's say water intrusion or let's say damage to personal belongings, property, relocation costs. It is purely a limited coverage, and we'll talk about the amount and extent of it for rebuilding purposes.
It might cover water intrusion if we had a tsunami. Like a disaster tsunami. Now, that's not really water intrusion,
right.
I'm going to say, hey, if the ocean is intruding in my home in a disaster, that's a water intrusion.
If you have a declared disaster or one of those types of events, fine. I'm referring to pinhole leaks let's say a roof has failed and you have some kind of a leak or intrusion.
It doesn't apply to any situation where the insurance hasn't pulled out of the market.
Correct.
So by definition, it wouldn't apply to pinhole leaks, right? It would apply to, for example, if we started having tsunamis for some reason, enough tsunamis where they were actually ruining people's homes, then insurance companies might pull out of the market because you live 200 yards from the ocean, you know, even if you're on these pylons. And they're like, well, we're not covering you anymore for if ocean water gets in your house, you're on your own. In that case, I'd say the FAIR Plan would apply.
The coastal line erodes and you have, again, the evolution takes it in a different direction, of course.
Right.
As we have it now, we have a $3 million limitation, right?
Well, let's not get to that yet.
Okay.
Let's not get to that.
Okay.
Okay. What I'm hearing, it was never designed to be your akin to your full comprehensive insurance.
Correct.
And the reason for that is, in theory, and this is up to the homeowner because they are paying a lot more for the really important coverage, which is replace my structure, right?
Right.
Homeowners can and do supplement with private insurance on things that you were just saying, like their personal property.
Right.
Or there are a lot of policies that don't cover pinhole leaks, but you can get policies that do. If, like, my regular insurance policy doesn't cover, it covers some water events like a burst pipe, you know, suddenly, but not a pinhole leak. But then I got coverage to do that. I pay extra for that. So that if I do have a pinhole leak, it would be covered.
Here's a simple example to illustrate it unambiguously. A dog bite issue. This policy does not touch it one bit.
No.
Yeah.
Yeah, because, exactly. Okay. Yes. If you lived in the Palisades and you were under the FAIR Plan, or you were in Altadena and you were under the FAIR Plan, if there are the high fire zones there, then, and you happen to have a bad dog, then you better have your own insurance for to cover potential dog issue, because the FAIR Plan isn't going to cover that.
Right.
Because it is limited. It is a specific type of policy designed to cover these catastrophic losses when the market has pulled out.
Exactly.
And I'm not aware of any market where insurance companies have pulled out of, covering dogs.
Right.
Now, and I don't know what would happen if you had a breed of dog that was hard to get coverage for, because you could always get coverage even for, the more aggressive breeds. You just pay a lot more for it. There is a market there.
Correct.
It's just, it doesn't mean it's affordable or fair. It's just, it's there. You're just going to pay through the nose. But so now let's go on to what you said.
Okay.
There is a coverage limit.
Correct.
On the FAIR Plan.
Yeah.
And the coverage limit is what it is. It's not a sliding scale. It is a limit. What is that?
$3 million.
$3 million. That sounds like a lot of money, and it is a lot of money. So there's going to be a lot of homes where it's going to completely cover. So median price of a home in Altadena, I looked this up. Let me be more specific. I looked up the median price of the homes in the areas where people suffered catastrophic losses during these specific fires. And I got numbers anywhere from $650,000 to $1.3 million or $1.4 million, something like that, if I'm remembering correctly what I read. In the Palisades, it's double or more than that. So if you're in Altadena, I don't think the cap's going to affect you, except in one specific case, which we'll get to shortly. But you're going to be pretty close. But if you're in Palisades and your structure, your house is actually $4 million home, you are going to have a gap in insurance.
Most likely, yes. Yeah.
Okay. So, and we're going to talk later about how that plays specifically in multifamily complexes or HOAs, condos and townhomes. It's a very different scenario there. We'll get to that shortly. But let's talk about, so let's say, God forbid, you and your family suffer a catastrophic loss in a fire. You're in the Palisades or you're in Altadena. Okay. You lose your house, right? That's gone. Okay. You have to rebuild. You get your architect, you get your plans together, right? You start to utilize SB 625. And then you get a check from your insurance company, or it goes toward construction, however it's going to work. But it's not enough to cover building your house because you've hit that limit. Now, you're fortunate for being in that situation. It means that you have a house that's large enough, right, to be beyond that $3 million limit. But if you think about it, when you think about costs of labor, supplies, and all the things that go into building the house and the materials that go into building the house, and it might be easier than we think to hit that number. Do you agree?
Absolutely, yeah. And again, that's not even accounting for other incidental expenses. The year or two that you have to live someplace else. That's a whole entirely different thing.
Right.
Yeah.
And by the way, part of that calculation of costs is it's not just supplies and the wood and all that, the stuff that goes into it. It's also the increased cost of conforming to the updated
Building
safety
codes.
codes.
Exactly. Yeah.
Because SB 625 doesn't excuse you from those. You still have to, if your house was built 100 years ago. I grew up in a house that when I was living there was 100 years old.
Oh,
okay. And I mean, it was great. We had some nifty stuff in that. It was amazing. Okay. But, codes were very different. Okay. As it turns out, the only family that lived in our house was the builder.
Oh.
It was the Edwards family.
Okay.
And that builder built that house to stand and survive any earthquake. So even before any earthquake requirements ever existed, that house is one of the few that went through relatively unscathed in that huge earthquake in the early 1900s, and I don't remember when, but that hit Long Beach.
Oh.
Okay. And it was our house was famous for that. It was one of the few that stood because the builder, the guy whose family lived at that house until my dad got it at an estate sale in 1977. That builder built that house to stand anything.
Yeah.
We had
good for them.
Very thick wall. I mean, it was
Yeah.
solid house. It was amazing. So most of the time, that's not the case. And so you do have to abide by these updated codes, and that costs a lot more. It costs more to comply with more codes.
Right.
So that also goes into the calculus, right?
Sure. Yeah.
So these shortfalls, this insurance offering to pay X, the actual rebuild cost being Y, higher, right? And who's responsible for the difference in a single-family home?
You are the homeowner.
Yeah, because who else, right? And you're not going to get it from any other type of insurance because I don't think if you could get traditional insurance on the build, then you do it.
Fair plan would not apply to you.
Then it wouldn't apply to you because you would do it.
Right.
Okay. So why? Let's now shift gears a little bit away from single-family homes. This next part's going to only be relevant if you live in condo or townhome. Okay? It's only going to be relevant to connected multifamily housing structures. For our example, let's say that your HOA consists of a bunch of condos, right? But they're divided into buildings. Each building has 4 floors of 5 condos on each floor. So 20 condos, 20 units per building. Let's say that, just to be consistent, let's say that's our example today.
Okay.
Okay?
Okay.
4 stories, 5 units per floor for a total of 20 per building.
Okay.
So, for example, if your HOA had 100, you would have
5 buildings.
5 buildings. And do the math from there, okay? Now, we did this in a show, didn't we? I can't remember which one. I'll put a link in the description. But we did a show on HO6 policies.
Okay.
And the HOA's policy and how those play together.
Oh, the interplay, yeah.
Yeah. Right? We did that. Am I imagining that?
No, we absolutely did.
Okay.
And we've referenced it in more than one episode, but we did one primary one on that issue.
Specifically on that issue.
Correct. Yeah.
Good. Okay. That's what I thought. Now, so we're going to assume both of those exist here. We're going to say that the homeowner has, let's say it's an HO6 policy. Now, keep in mind, because we're talking about multifamily housing now, the structures that we've been talking about are not owned by each individual homeowner. They're owned by the HOA. So these homeowners are going to have these HO6 policies because the homeowners themselves aren't going to be on the FAIR plan.
Correct.
Because they're not the ones that would cover the building in this high fire zone. That's the HOA. Their HO6 is going to cover what HO6 covers, which is personal property, most of the time upgraded finishings, stuff like that, maybe relocation during reconstruction. There might be limits, there might not, I don't know, but that's the sort of thing. So we're going to assume those are in place. Those haven't been affected. But now, by implication, I think it's obvious that HOAs are in the same boat as the homeowners of the single-family homes in that the insurance is pulled out of the market for them too. So HOAs can be on the FAIR plan as well. It's not just individual owners.
Correct.
It's corporations, for example, like an HOA.
And in most HOAs, including those that are not in fire-prone zones, in case of full destruction, those are typically tendered to the master policy with the HOA's insurance carrier. So that illustrates where the allocation of responsibility lies.
And instead of now being their master policy
is the FAIR plan.
At least for rebuilding, is the FAIR plan. And then, sure, they'll have supplemental insurance for the other things that they're required, including the E&O that they're required by code to have, right? So they'll have that separate because that stuff isn't part of the FAIR plan. But just as traditional coverage isn't available to individual homeowners in a single-family home environment, it's not going to be available to HOAs in the same fire zone. So they got to go on the FAIR plan like anybody else would.
Right.
If you've been reading the newspapers lately, there was one in the news recently. There was a condo complex in Altadena that just passed, or just forcibly passed under the emergency rules, passed an assessment of $23,000 and change for each household. Now, the news story, I think, was addressing not necessarily that the special assessment was inappropriate, because what the HOA doesn't have a choice. It has to get the money from somewhere. It was the manner in which it did this. In that news story, there was a 34-day payment period. There were a lot of questions that went unanswered. Now, we talk in a lot of our shows about the bad HOA lawyer out there, in particular that professional promoter who has no business styling himself as an expert in any area of the law, including HOA law, but his ubiquitous spending makes him the perceived expert. And he was quoted in this. And instead of offering any real help at all, and I did a fact sheet specifically on this story and on the ignorant comments that this lawyer made, or the unhelpful comments this lawyer made. I did a fact sheet. I'll put a link to that in the description. But this professional promoter that I like to talk about a lot offered nothing substantive or useful or helpful as a quote. He made a statement about something that was completely obvious. Yeah, you should probably take a look at whether or not they pass a special assessment properly. Oh, thanks, Captain Obvious. Appreciate it. Good job. How about some questions that homeowners could have asked that actually would have mattered? And I went through a whole bunch of them that just came off the top of my head in that fact sheet that I'll give you guys a link to. The point being that this article is talking about this very issue.
Yeah.
Now, I put a comment in my fact sheet because one of my questions was, why was there a $6.4 million insurance gap? Has anybody asked about why? Was the HOA underinsured? Was there past negligence on the part of the board that resulted in that, that necessitated a special assessment to cover the gap? But at the end of that section, I added a comment that said, and of course, although the story didn't touch on this because the reporter didn't, I don't think reporters today a lot of reporters today I don't think they're the same. They don't have the same quality of workmanship that reporters of the old days did pre-internet. But this reporter left out so many things that this reporter could have written about. But regardless, they didn't say anything about whether these particular homes in this specific complex was located in one of those high fire zones and whether those homeowners were all under the FAIR plan. It is silent. But I have a comment in my fact sheet. If they were,
right,
then that would explain the shortfall. It would explain probably what the gap was, why there was a $6.4 million gap. And that wouldn't be because of anything the board did wrong in that case. But I still pointed out the fact that what the board did wrong in that case was the manner in which they did it. There are so many things that an HOA can do to ease the pain of a special assessment. And I'm not going to go into them in this podcast because this isn't what this is about. If you're interested in those, read that fact sheet. Again, I'll have a link to that in the description. But this is in the news. It's happening. Okay? So let's talk about now the interplay between the FAIR Plan and SB 625. And I'm going to let you take this one away on your own. Keep it short and keep it sweet because, to be honest, they have served different purposes.
That's exactly it.
But people are going to ask.
Right.
And because people are going to say, well, they passed this law right after the fires to help homeowners, so why isn't it addressing this? Well, SB 625 has a purpose.
Yeah.
And the FAIR Plan serves a completely different purpose. Talk to me about that.
Well, you just gave a really good introduction for that. The short of it is SB 625 specifically addresses streamlining the process with HOAs to rebuild these homes. Okay, meaning that architectural guidelines, rules, CC&R restrictions that either prohibit or substantially curtail or impede the rebuilding or reconstruction process are effectively rendered null and void, and HOA boards shall not interfere with a streamlining of that reconstruction process, nor add significantly to the cost of reconstruction.
Or local city government.
And municipalities as well. And they have specific codes that relate to city staff and local municipalities.
So that's SB 625
that's
is
25.
actually how to get it.
Right.
Okay.
And then we did the full episode on that, and folks can refer to that for more nuanced detail.
Or the fact sheets.
Or the fact sheets, which are fantastic, by the way. And potential clients whom we've met with say so. They've reviewed those. The FAIR Plan is not intended to deal with the streamlining of the reconstruction and municipalities and things of that nature. It is the stopgap insurance, which we just said. It's an insurance and coverage of last resort.
To pay for it.
To pay for it, where the marketplace has basically left room for that to be necessitated.
That's right. I couldn't say it better myself. That's it. We're done. Okay. SB 625 deals with how you rebuild, and the FAIR Plan discussion we're having today deals with how you pay for it.
Yeah.
That's it.
Yep.
That's it. Okay. So now let's talk about what homeowners need to understand right now. Now, when I say homeowners, I mean homeowners that live in those high fire zones that are subject to the FAIR Plan. If you're not, this episode is just for interest's sake.
Right.
It's not going to affect you, knock on wood. Okay.
Yeah.
So normally at this point in the podcast, this is where we talk about the real world tips and tricks and suggestions that can help you solve whatever problem is being addressed in the podcast episode. This is the part where I specifically talk about, here's how you can help. Here's how you can help yourself. Here's how we solve this problem.
Right.
But in this case, there's no checklist I can give you. Okay? There's no fix to this problem because the problem exists today because of the fact that there are insurance companies that don't provide coverage, and something has to happen to help people so they don't suffer irredeemable catastrophic losses to the ruin of their entire fortunes. Okay?
It's very difficult to offer quick fixes or a checklist when you have regulatory and marketplace conditions that impede that.
And that's what the point is. If you're on the FAIR Plan, you're dealing with a system that has real limitations, and those limitations don't just go away because you understand them now.
Yeah.
Okay? Now, for many of you who live in one of those high fire zones where you can't get that traditional coverage, okay, there are only 3 possible outcomes, okay, after a major catastrophic fire, okay? You rebuild, accept whatever your insurance company under the FAIR Plan, the max out and they give you, and then pay the difference if there is one. You rebuild and you take on debt, or you don't rebuild.
Yeah.
That's not really an option, right? I don't believe that's an option. So those are hard outcomes. Those are the only 3 things that could possibly happen. Those are hard to hear, and they're real. And everybody that has lost their home is facing that choice of 3 things. Now, the third one, again, is really not a choice, but it technically is.
I guess you could tack on the possibility of a sale to that third one. Yeah.
Well, no, because what are you going to get? Even if 80% of the value of your home is the view, which wouldn't be affected, okay, you're still going to be short 20%. Right. Yeah. So if you sell it, you're going to get the value of what you're selling. And if there's no home on there anymore, you go ahead and clear it.
No, you sell the land essentially in the view possibly.
Right.
Yeah.
Which could be worth something, but it's not going to be worth what it was when you had a house on there. So there are some potential solutions to this problem, but these are not solutions that you individual listeners can employ or put into effect to improve your situation. Like normally is the case, I give people real world tips and tricks and techniques and things they can do immediately for themselves. The solutions to the problem we're talking about today are not in your individual hands. They're in the collective hands of the voters. Mm-hmm. So before I discuss those, before Sam and I discuss these, I want to make the following crystal clear, okay? We're not here to defend insurance companies. I hate them as much as the next person. Right. I have the same strong feelings toward insurance companies that most people have, gut reactions, okay? I'm not here to defend our current system. I'm not here to explain how any of this how these changes in policies could play out for individual homeowners. And I'm not here to take a side. I'm not here to assign blame to Republicans or Democrats or anything like that, okay? The only thing we're here for is to discuss potential solutions to this large-scale problem. And they can fall into a variety of different belief systems, okay? Mm-hmm. I'm just here to kind of communicate the ones that occurred to me, okay? There's probably others, okay? I'm also limiting this part to things that are not in effect today. For example, there is something called reinsurance, but that's legal in California. And reinsurance is basically insurance companies getting their own insurance to help cover the costs when they have to pay out to catastrophic losses. Right. And there is a world market for reinsurance based in Europe, largely. Like there's a Swiss company and there's a German one. And these reinsurance companies basically would insure Allstate or State Farm or Farmers, so that when State Farm has, 100,000 claims all come in after a huge, tens of thousands of homes burned down, they actually have insurance to help them. Mm-hmm. But that's legal now, so I'm not going to talk about reinsurance, okay? So I'm going to talk about things that don't exist, what would have to change, okay? So with that in mind, here are some possible solutions. One of the ones I came up with is to reduce the current environmental rules. And I'm narrowing it down to two issues. Do you remember one of them? I know we talked about
clearing vegetation and brush fires.
There are a lot of environmental policies in place over the last 20, 30 years that have made it very difficult for whether it's CAL FIRE or private owners or corporate owners to clear brush. Right. And I'm talking massive brush clearing. So what's happened is we have in large swaths of California decades, not just years, but decades of overgrowth that has died and just builds up and builds up and builds up. Mm-hmm. That's a big, big factor in the severity and amounts of wildfires we've been experiencing in California over the last decade or so. You have decades of not clearing out the dead brush. Okay, mm-hmm. That's a big one. And the second one was CAL FIRE and other state fire agencies used to perform controlled burns.
Correct.
To do exactly what we just talked about.
Yeah.
That has largely been made either impossible or virtually impossible.
Very limited, yeah.
Okay. Mm-hmm. Bottom line, a solution would be to reduce the current, notwithstanding the environmental, we got to worry about this bird or this owl or this fish. You fast track municipalities' ability or CAL FIRE's ability to remove either through a burn or otherwise dead brush. And you secondarily take into account any endangered bird or something that might be in those areas. That is a policy decision that would have to be made. Mm-hmm. It could be. It is a potential solution. I'm not saying I support it. I'm not saying I don't support it. I'm simply offering it as that is one solution. Mm-hmm. Okay? Here's another one. Do you have another one?
The other one would be, as far as the market conditions, regulatory impediments to insurance carriers.
There you go.
Not imposing artificial caps on raising premiums that force them out.
So let's talk about that one. All right? Mm-hmm. So California again, no political issues. For better or for worse, California has more regulations on insurance company, I think, than any other state. That's a guess. I think I'm right about
You're
that.
probably right, yeah.
Okay. You might remember back in the late 80s, California passed Prop 103. Prop 103 basically said that insurance companies couldn't raise rates without getting permission from the state insurance commissioner.
Yeah.
So it's actually a long process and it's hard. They can't react to market conditions, changing conditions in issuing policies because it takes so long to get those approvals. And as a result, insurance companies that might have stayed in the market, if they could more easily pivot and adjust, pull out because it's easier to do that than it is to get through the rigmarole.
Right.
So one possible solution would be remove some of those regulatory conditions. And again, I start out by saying I don't like insurance companies. I believe from the bottom of my heart that insurance companies will do whatever they can within the law to take advantage. Sometimes outside the law, they violate the law. They take their statistical risks and will deny all coverage for a period of time, knowing that what they're doing is wrong and illegal. But they also know that not enough people are going to challenge it to actually matter to them. I know this is going to happen,
right.
But one way of keeping people in the market is to reduce some of those impediments to allowing them to pivot. Another thing is, maybe a repeal of Prop 103. The point is that Prop 103 existed for that reason. I think it was 1988. Okay?
It was.
All right.
Yeah.
So, or on the flip side of that, do something to encourage insurers to stay in the market when they want to leave. Okay? And that could be a 103 thing, right? Reducing pricing constraints. Here's another one. Do you know about the backward thinking and forward thinking? Remember that?
Okay. No, remind me again.
So, a lot of insurance companies, if they had their druthers, they would use what's called forward-thinking models in coming up with...
Oh, yeah.
Right.
And so risk assessments, yeah.
Right. But California, I believe California doesn't allow that. I believe California only allows them to use backward models. That is, look back at the past in determining what might happen in the future and setting rates, as opposed to looking at patterns and then doing a future model,
right,
and then basing rates on something that hasn't happened yet. I think that's illegal in California. If you were to take that impediment away, it would probably keep certain insurance companies in the market. Again, I'm not fostering any of these. I'm simply offering them as every one of these individually is a potential thing that could help reduce the necessity of reliance on the FAIR Plan. That's all I'm saying.
Right. Yeah.
Okay. Here's another one: public-private risk pools and catastrophe funds.
Yeah.
Other states do use these. I know Texas has them for hurricanes.
Right.
And I know that parts of Europe have them for floods. And I can't think of any country or state that has them for wildfires, but why not?
In Europe?
Anywhere.
Oh.
But why not?
Okay.
So what a public-private risk pool is you have kind of a hybrid situation where a state might offer tax incentives or might kick in a certain percentage if insurers are staying in the market and paying a certain percent, right?
Subsidies, yeah.
Or they might cooperate in a bond to help cover over a certain number to help cover the catastrophic losses, right? There's a bunch of ways you could do that. There are some of those that probably are legal in California, and then there are some that I don't think are. I'm just saying you could look at that, okay? I'm not an insurance expert, so I don't want to go further than that, okay? Here's one, though. I happen to remember I think it happened in Palisades and Altadena, is that some of the fire companies lost water. They lost water pressure completely. They couldn't do anything. Hoses went off. Water delivery systems were taxed, right? It would cost billions, but there are infrastructural, I should say, improvements and changes that could be made to our water delivery systems to ensure that doesn't happen again.
Right, yeah.
Who knows how many homes could have been saved but for that water going off. But I remember that made the news. That was all over the place. Water just, at the fire hydrant, just went off, okay? So improving water delivery systems, building new reservoirs. I mean, there's a lot of things, okay? What we're seeing now, folks, is more homeowners are being pushed into the FAIR Plan because of the severity, increase in number and severity of wildfires in California. They're paying a lot more for less. There are specific caps on the FAIR Plan that are making it necessary for individual homeowners to come up with the difference and HOAs to specially assess to come up with the difference. And these gaps turn into community-wide financial exposure, which can be minor or they can be major depending on that gap. And it doesn't appear to be slowing down. Wildfire risk in California is increasing.
Yeah,
okay? There are a number of factors that go into that. It could be more people are moving into areas that are more prone to wildfires than ever before. That could be one of them, okay? But certainly fuel buildup, lack of controlled burns, lack of clearing out, lack of infrastructure on water delivery systems, insurance regulations that drive some insurance companies out of the market, all these things, and then maybe climate change, all of them work together for whatever reason. They're working together in tandem to cause this problem. And this problem being, we're seeing more fires, hotter fires, fires that burn more. It could be all of those things. Mm-hmm. The only way that this will change is if there are some systemic changes that are approved by the voters. What those are remains to be seen. We're just here to deliver the news. But if you live in one of those FAIR Plan areas and you lost your home, and you have found that you are underinsured, at least now you understand why.
Yeah.
If you're in a multifamily unit and you are facing a special assessment, setting aside the manner in which your HOA is doing that, there's a right way and a wrong way to go about it. And that HOA in the news story went about it completely wrong way in so many different ways. Mm-hmm. But the money, they do have to get that eventually. If you're wondering why, that could be it. That could be the reason, not because of any shortfall on the part of on the HOA, but because of the shortfall built into the FAIR Plan. So at least now you know.
Yeah.
If you like this episode, please hit the like button. And if you haven't already done so, please subscribe to the channel, HOA Hell. If you have any questions, please leave them. I answer those questions routinely. Until next time, have a wonderful day.